All right, so today I wanted to make a video on a stock that I've been dollar cost averaging for about the last year. Never talked about it before. Domino's Pizza. Now, again, everybody knows what Domino's Pizza is, right? Again, $13 billion company, so they're probably mid cap, if not bordering on large cap, depending on what your definition is there. Again, dividend 1.25%, free cash flow yield of 3.46, 52-week range 285 to 409. And again, like I said, everyone knows who Domino's is. I'm not going to get into what they do. Again, this is a company that I believe is one of the top performing, I think in the top 10 or 20 companies in the S&P over the last 20 years. They're up, 2,800%. The S&P about 300. So again, they've almost 10x the returns of the S&P. Now again, I don't think that that's going to happen over the next 10 or 20 years. I'd be absolutely shocked. My prediction would be that they slightly outperform, but again, they also have a very nice dividend, which I'll get into. So if we get into the insights here, let's get into the insights. Financial health, the one area that definitely is the most concerning to me, and this is the one thing that drags the stock down, is the financial health. Again, current ratio is actually okay, although they do have more debt than I would like. Again, their debt to EBITDA is also concerning. Growth is average, I'd say. Management, a little bit above average. Profitability, probably a little bit above average. If we look at the valuation, again, price to free cash flow of 28.9, 5-year average is 32. I would say where they're at right now, in my opinion, and based off the data, it's about fair value, right? It's about fair value. Again, it is near that 52-week high, although I think that if you could get it in the mid to low 300s, I think it's a steal of a deal, and I'll get into that here in a second. So if we go into the financials here, if we check out the balance sheet, they do have more liabilities than assets, quite a bit more, which is definitely concerning. If we look at the cash flow here, they have been buying back shares very consistently over the last at least 7 or 8 years, which is very nice to see. 2022, they actually bought back a record amount, which is very good to see. They paid down debt last year, although they took on quite a bit of debt in 2022. Paid down debt, took on. So again, they're kind of inconsistent as far as that goes. If we look at the free cash flow here, it was growing actually very nicely up until last year. Right up until last year, it went down, and it went down pretty significantly, at least compared to the last couple of years. Right. Why that is, I think that's probably a slightly weaker economy. Although in my position, I think over the long run, this is a company that's going to do pretty good. And my theory behind it is that when times are good, people are going to be spending money, right? They're going to be having parties, again, you name it. When times are bad, I think people still want to splurge. But if they are going to splurge, typically they need to splurge in less or cheaper ways. And Domino's has always been, at least in my area, it's on the cheaper end. It's good quality. That's why the stock has performed so well, and that's why they've grown so well. But it is cheaper pizza and cheaper food, at least compared to a lot of the competitors. But it still is good quality. Like, it still is good quality. So that's why I think that they'll do good. And I think another reason too is that there's still a lot of room for growth, given the population growth in North America and given the population growth in Asia and South and Central America. I think that there's a lot of room for expansion as far as companies like this go. It's pretty easy to open up a pizza place, right? It doesn't take a lot of, again, it's like opening up a McDonald's or something like that, right? It's pretty easy, right? If we get into the metrics here, so again, that's kind of my theory on why I think the company will do good. But again, the one thing that I would mention too is that they don't have a massive moat necessarily. That is one thing that is certainly concerning, because I've never met someone. I mean, maybe in small towns I've seen where there's people like, yeah, I have to get pizza from this place, but that's because there might not even be another competitor, right? But in cities, I don't think that there's a lot of people that are like, yeah, I'm only getting from Domino's, or I'm only getting from Little Caesars or Papa John's. Like, not a lot of people like that, right? And if it is, usually it's a local place. But I mean, the big chains, usually people are just going to go with who's giving them the best deal that has a quality product. And that's why I like Domino's, because as far as the other chains go, I think that their product is the best, at least for the price, right? If we look at the metrics, net margin, operating margin has been very consistent over time. I mean, if we go back, 15 or 6, let's go back 10 years just to be, get a decent comparison here. The lowest it's been is 16.9, right? 16.6. The highest it's been is 18.7. So again, they're not crazy profitable, but they are solidly profitable, right? They do have solid profits. Again, free cash flow margin is between 8% and 13% every single year, right? That's what you want to see in companies. Now, again, this company, I would prefer if they were more profitable. Absolutely, I would prefer. But the fact that they're clearly, consistently profitable is very good to see, right? That's very good to see, and that's why I'm interested, right? So again, that is the metrics. And again, if you look at the operating cash flow, again, very consistent there as well. Again, the best thing about this company, in my opinion, is the dividend, right? 1.25%, but they're growing at 17% per year, right? You go back 10 years, you have over an 8% yield on cost, right? Over an 8% yield on cost, right? You go back, let's go back 20 years. You have a 27% yield on cost, right? If you'd have bought this company during the '08 crash, you'd have over 100%, right? So that is why I like this company, right? This is probably the main reason, right? They don't have a high dividend, right? Because, in reality, you don't care about the dividend today. You care about the dividend down the road because you're not investing for right now. You're investing for 10, 20, 30 years down the road, right? So that's why I really like it, because I think, again, you're going to have an 8% dividend 10 years from now. You're going to have a 20 or 30% dividend 20 years from now, right? That's what you want to see. And again, I'd be shocked. People are not going to stop eating pizza, right? So again, this company's, their market share may go down over time, but I don't think they're going anywhere. And on top of that, I still think that they got room for growth, given the amount of growth and people coming out of poverty in some of these third world countries. And the fact that their product, it's not an expensive product. You don't have to become super rich to afford a pizza, right? So that's another reason that I really like it. Let's get into the metrics here, and then I'll leave it at that. If we look at the operating cash flow here, it's a very consistent number, right? It's a very consistent number. If we go back, let's go back 10 years. The lowest the operating cash flow has gotten is, the low was 18.6, and that was in 2013, exactly 10 years ago. And the highest it got was 32.7, that was in 2018, exactly 5 years ago. The average is 25.7, the latest is 24.1. So honestly, in my opinion, you're not going to see the levels of growth that you've seen out of this company over the last 10 or 20 years. I don't think that that's realistic. That would be borderline impossible. But I do think you're going to see levels of growth that are going to beat the market. So I think a 24 price to operating cash flow is probably about fair value, right? Ideally, you want to get companies when they're cheap, and that would mean you'd want to get it cheaper, maybe 10%, 15% cheaper. If it went down to $350, I think you'd be starting to look at a good deal. In the low 300s, I think it's a steal of a deal based on current metrics, right? So again, if we look at the free cash flow here, it's in such a nice little range. And this is another thing I like about some of these companies, is that you're not going to get crazy growth, but they're predictable, right? They're predictable. So again, when you see this company go down, in May, it was at a 20-21 price to free cash flow in May and June. Clearly, it was a steal of a deal back then, because again, the lowest that price to operating cash flow has been 19 or 18 point something. If you can get it at 20 or 21, that's a really good deal, right? So I think you'd want to get this company at that 21, 22, even 23. I'd still be buying if you can get it there, right? So this is something you're going to want to keep an eye on if you're interested in this company. So anyway, that's what I wanted to talk about today. If you liked the video, hit that like and subscribe, and stay tuned for more.